Hello everybody and welcome to this video entitled The Best Hypergrowth Stocks in My Portfolio. I haven't done this video in 12 days. So in the comment section, please don't tell me I always make the same videos. These are every 2 weeks. I try to update this for you all every 2 weeks. And so still on the road, don't have a lot of time to cover it, but here is the spreadsheet. So this is probably what you're interested in, and you can do a screenshot if you want. And if you're new to the channel, welcome. Let me just give you a little commentary on my portfolios spreadsheet, these that I share, every other week. So what's the most important metric in this spreadsheet? Well, that is this metric right here, enterprise value over gross profit over revenue growth. This metric combines growth and value together. This metric asks the question, how much am I paying? What is the cost of each 1 percentage point of growth, of forward growth? How much am I paying for each percentage point of forward growth in that company in terms of revenue, right? And so I use enterprise value because enterprise value penalizes companies with a lot of debt. I use gross profit because gross profit is a better indication of the economic prospects of the firm, right? Because accounting, when you use net margins, accounting has this bad habit of looking at, say, investments in marketing or investments in R&D as an expense. As you know, if you follow the channel, I definitely don't consider these an expense. And so I think gross profit is a much better assessment of a firm's profit potential and future potential rather than net profits, which net profits include things like investments in marketing, like investments in R&D. And I use revenue growth really as a proxy for the growth in gross profit, because gross profit over time doesn't change that much. It is the net profits that will change, but gross profits over time do not change that much. And if this formula seems familiar to you, it's because it's kind of a modification of the price to earnings to growth ratio of Peter Lynch, right? That's my own version of the PEG ratio, which I've modified for growth stocks, and I prefer to use that. And here's another feature of my investing. I typically want to invest in companies that are going to grow at least 30% per year revenue growth, at least 30%. The reason why I do that is because I want to beat the denominator. The name of the channel is Beating the Denominator. And I view a company who grows revenues at 15% as a company that is just staying afloat. Because if your company grows revenue at 15%, that's how many more new dollars are issued each year. So your company is just staying afloat. To me, to grow faster than the growth of dollars out there, the growth in money supply, a company has to grow faster than that. And to grow faster than that, ideally double that, right? They need to achieve 30% revenue growth. That's my target, 30% revenue growth in nominal dollars, and that should lead to about 15% real returns. But of course, the nominal returns are going to look outstanding. That's because most people forget to remove the devaluation of the dollar from their assessment of the companies. And a lot of these companies, of course, are high growth companies. Why are they high growth companies? Because I invest in product adoption. I believe revenue is the best proxy for knowing whether a product or a service is getting adopted. And in a nutshell, my style of investing is I invest early at early signs of product adoption or service adoption is when I invest, and I buy the stock, and I try to exit the stock as soon as there's a sign of a growth slowdown, as soon as revenue growth abates. And now that I've put that out of the way, let me tell you a little bit about my holdings. So my number one holding by a long shot is Tesla. Tesla is about 40% now of my portfolio. Some may say it is unwise, but I find Tesla to be very, very, very undervalued, despite the fact that my spreadsheet is showing it literally as the most highly overvalued. I mean, I don't think it's very highly valued, but I think per my spreadsheet, this is the highest valued, the most expensive stock out of all of the 10 stocks that I own, and yet it's 40% of my portfolio. And a lot of this has to do with the fact that I view revenue growth for a company like Tesla to be much more than 37%. I think they're going to do above 50%. over the long run, until 2030, I think they're going to grow revenue at above 37%. And cynics may say, well, cars are slowing down. You can't grow this fast. Cars, it's not possible. Well, it's forgetting, say, things like Tesla Energy, which is growing at 100% right now. And we know Tesla Energy, as Musk has pointed out multiple times, Tesla Energy may very well be bigger than the cars, right? And AI, of course, may itself very well be bigger than the cars too. So this is the Standard Oil of our day. Tesla is the Standard Oil of our day, and I'm very happy to own it. I believe this will be the most valuable company in the world by 2030. Stuff for me to tell you, I have no doubt about that, but that's the asset where most of what I have is in that asset. So I have a credible commitment to this statement, right? I'm just not making a random video. I put the money where my mouth is, if that makes some sense. Enphase is a stock that I really like. Enphase is a bet on the adoption of solar roofs and solar energy, and I believe the need for energy is going to triple over the next 10 years, and this comes from a book I'm reading right now called The Coming Wave, and they go about $4.5 trillion worth of revenues are up for grabs in the future within the next 10 years for energy. And Enphase, I believe, is going to be part of that revolution, because I view most, residential homes, single-family homes, most of them I view as having solar. You have a roof anyways. Why not add solar, especially as we get to a point where solar is about the same price as plywood? And that is true. I've covered this multiple times in my video. If you buy last year's version of solar, the cost of a giant solar panel is like $60 on Alibaba. That's how cheap they've gotten, right? That's how cheap they've gotten, and I think solar will be pervasive. That's why I own Enphase as my bet on solar. MicroStrategy. So MicroStrategy is my second. Well, it's Bitcoin, right? Bitcoin. I own mostly Bitcoin, a little bit of MicroStrategy, but I put all of these together in the same asset. That's my second biggest asset that I own is Bitcoin. I've been on and off with Bitcoin since 2015. This is an asset in which I have grown a lot of conviction. I know it may seem odd to a lot of my viewers that I enjoy and like Bitcoin, but I think Bitcoin is a direct answer to the dilution problem. It's a macro answer to the problem of monetary dilution, the problem of the US dollar. Over time, 99% chances it's going to go to zero over 100 years, right? Which is what Charlie Munger says. Anyways, I believe Bitcoin. I believe in Bitcoin very much, and it's a big position for me. It's a position I've been adding to. If you look at the positions I've been adding to lately, that's Tesla, that's Enphase, that's MicroStrategy and Bitcoin. That's a little bit of StoneCo, a little bit of Nubank, and a little bit of HIMS. I've been adding to this position. I haven't touched very much my other positions. Okay, let me move on to HIMS. HIMS stock's doing so well. They're launching their weight loss program. A lot of us are very hopeful for weight loss programs that they're launching. I think a better offering than a lot of the Wegovy and Mounjaros of the world. I think their offering uses established molecules that are going to be a hit in the market. I believe HIMS is often discounted as this ED drug company, and when it's not, people are kind enough to discount it as an ED and hair loss company. In my view, HIMS is much bigger than that. HIMS, and I've covered it multiple times on the channel, it's an e-doctor plus an e-pharmacy without insurance. And without insurance, why? Because since you disrupt pharmacies, right? They have 2 automated pharmacies in the US. So you disrupt the pharmacy business. As a reminder, there's 45,000 retail pharmacies in the US. Do we need 45,000 retail pharmacies in the era of same-day shipping? In my view, the answer is clearly no. So that's part of what HIMS is addressing. The other part of what HIMS is addressing is the providers, the doctors. Do you need to go for a health system and pay for a hidden real estate empire, quote unquote, while you can just have AI-enabled doctors and prescriber specialists give you your prescriptions? And that's where HIMS also comes into play. HIMS create a platform where doctors can sell their extra time to prescribe needed drugs and needed treatments to people who go on the HIMS platform. And so I believe they are highly disruptive, but HIMS is the type of company that if you don't spend 5 hours studying it, it's going to be tough to see the bigger picture. Because on the face of it, it doesn't look very appealing. And surely the market has punished him with an awful valuation, if you ask me, compared to its potential, in my view. CrowdStrike. I mean, this is a consensus stock, as consensus as it gets. CrowdStrike is, kind of highly valued like a Tesla, but without the debates around the Tesla. Yes, CrowdStrike is the winner in endpoint security for your devices. It is the quote-unquote antivirus or cloud-based antivirus of the modern day, and it's a winner-take-most market, and it very seems clear to me that their software Falcon is going to win that entire marketplace. And if you look at CrowdStrike against their main competitor, SentinelOne, the divergence is impressive. You have CrowdStrike just flying high and SentinelOne just going nowhere, which is to tell you that this is a business that is enabled with network effects. And these network effects come from having these hundreds of millions of devices that stream data about breaches whenever there's one to the whole network. And the whole network of computers that use CrowdStrike updates in real time, which makes it a wonderful threat deterrence tool. If you have a career type job and you work some big company, the odds are your company uses CrowdStrike, right? The odds are you have Falcon set up on your laptop or on your endpoint devices, on your phone, etc. Moving on to e-commerce, my favorite play in e-commerce is Mercado Libre. Mercado Libre is, quote unquote, the Amazon of Latin America. There's Amazon in Latin America, but they're not leading. Mercado Libre is leading. There's not much more to say about that. Lots of hopes with Mercado Libre, with the fintech division, the advertising division. They have their own fulfillment network, their own website. It's the most popular website in Brazil and in many other places of America. The only thing they don't have is the cloud, but that also explains why the valuation is only $74 billion. It's a very inexpensive company for where I look at it. And Mercado Libre is a very steady Eddie type of stock as well. Not a lot of disagreement on Mercado Libre out there. As far as the payments go, my payments play is Stonier. Stonier is a dirt cheap stock, but it's the beauty of Stonier is that it's a stock that grows very fast, right? 41% predicted forward growth. By the way, all of these stocks grow very fast, if you've noticed, right? All of them, the average growth for all of them combined is 42% average forward revenue growth. So that's the hallmark of my type of investing. I invest in this. Remember, I want to invest in stocks that are early in the S curve. I invest in this part of the S. I don't invest here. Pre-revenue companies that don't have revenues yet, I don't touch. And I don't touch companies that are established. I invest really at the heart of the S curve. That's my style. So anyways, StoneCo grows fast, great gross margins. The stock is very depressed. The reason why the stock is depressed is because going on 3 years now. 3 years ago, they had an issue of collateral. They had to write down $500 million. They lost $500 million. And as a result of that, the stock was punished and is down 95%. It was forgotten. It is still forgotten. The StoneCo is a stock that is owned by both Warren Buffett and Cathie Wood. Think about that. Cathie Wood likes StoneCo for a disruption of the growth. Buffett likes StoneCo for the value. What a weird match. What an odd match. And still both companies... both investors own the stock. Over company in the neobank space, I have two. I have Nubank and I have SoFi. Nubank is the leading neobank in Latin America. It's overwhelming, how leading they are. There's not much to say. Again, another consensus stock. Nubank tends to be loved by institutions, actually, and I love it very much because of the growth at 85% predicted forward growth. That's just insane. I mean, that's just stunning growth. They have their copy-paste business model where, they've been successful in Brazil. Their system has worked very well in Brazil. And then they take their banking system, their infrastructure, and they copy and paste it in different countries in Latin America. This is why I believe this stock has very strong potential. And the other stock that I own in the space is SoFi. Now, SoFi is a heavily debated stock. I have myself contributed to the debates. Turns out I used to be fearful with, I still own SoFi because it's a deep value. It's a very cheap stock. But I used to be fearful with SoFi with the student loans and the moratorium on student loans. Turns out that was no biggie, nothing at all, not a problem. But what turned out to be a problem is the confirmed rumor by an insider that they're exiting crypto. And to me, this is going to hurt them over the long run. Over short term, of course, we won't see a difference. But over the long run, I believe not having crypto is going to be a big problem for product adoption. So I'm slowing down my buys of SoFi. I am not adding to SoFi right now. I'm waiting to see what's going to happen with crypto. I'm particularly hoping there's not going to be a lot of backlash, because if you've been using SoFi and you've been buying your crypto diligently on SoFi, and then SoFi kicks you out because they're banning crypto and sends you to a website that frankly nobody uses, blockchain.com, you're not going to be happy. So I hope they're not going to have a backlash a la Robinhood, just like when Robinhood did their whole mess with the impossibility of getting Dogecoin out of the platform. You know, I want to be careful. Crypto people tend to create backlash sometimes, and so I'm a little careful about that one. Still think the stock is a deep value at this price for it. At $6 and change, SoFi is trading at right now, $6 and change. Deep value in my view. The last stock I have in there is Airbnb. Airbnb has had a little bit of a slowdown in growth. They're predicted at 22%. I think Airbnb is a much bigger story than just the disruption of hotels, even though they still have a long way to go at disrupting hotels. CEO on the call is on the record saying they're only 10% of the way in what they think they can disrupt of hotels. Of course, to me, owning Airbnb, the bigger picture in owning Airbnb to me is the disruption of mom and pop rental. That is, renters that stay more than 30 days. You may know that about 20% of people using Airbnb stay and live in Airbnbs for more than 20 days. I believe this is their next wave of growth, and that's part of a grand reason as to why I own this stock, and I'm very happy to own it. So this was very quickly, very briefly, my top 10 stocks. I don't have time to go in depth into each of them like I used to, a few weeks back when I made these longer videos, because I'm on the road right now. But I still hope that you enjoy this video, and I hope you'll give me a like. I hope you'll subscribe to the channel. And remember, this is not investment advice. This is just entertainment. Thank you for watching, and have a great day.